the premium for variable life is fixed. So it's typically a little bit less expensive than a traditional product. So let's say that the premium is $900 a year. I get the same face amount that I've always been discussing. What's my cash value going to be in the 10th year? Do you know? No, it's variable. It could be doing great and it could be doing not so great. Because it is still life insurance, you do need to understand that the least that is paid when you die is the face amount. It's called the minimum death benefit. So that when you buy variable life, if the cash value does horrible, let's say you're 65, you thought your cash value would be $80,000 by now and it's only $17,000. Is that possible? Yes. How are you guaranteed to get your face amount? That's right, you've got to die. But at least you know that the least that's paid when you die is guaranteed. So the cash value is going to fluctuate. There's no symmetrical chart that I can draw. The cash value is going to go up and go down. But the least that's paid when I die is the policy's face amount. And it is possible to have more than the face amount paid when I die. With variable life, if there's excess in my cash value when I die, they will look at how much is extra in there and they will buy more insurance with it. For example, let's say that I died at 35 and there was $5,000 extra in my cash value, or I died at 65. In which situation is the $5,000 going to buy more insurance? Obviously, when I'm younger. And that more insurance that it buys when I die is called the variable insurance amount. So with variable life, do you always know the least that's paid? Yes, that's the policy's face amount. Is it possible that more than my face amount is paid when I die? Yes, it just depends. Variable life, the premium is fixed. Don't forget that. The last one that we have in this section is variable universal life. They mix the best of these products into one. So VUL, this is commonly called variable universal life. Variable universal life. So we do not have a fixed premium with a VUL. We still have a target premium. And we have two death benefit options, A and B. And death benefit A, just like it was with universal life, is the face amount. Death benefit option B costs extra, the face amount plus the cash value. So just as it was in universal life, the face amount is made up of term insurance. But in a variable universal life policy, this cash value, well, let me ask, where do you think it is? In the general or separate account? Oh, yeah, it's in the separate account as self-directed by the insured. So that this is the policy that allows the insured, the client, to choose how they want, usually within a realm of choices within a family of mutual funds that you offer them to choose from, how they want their money invested. Do they want it in growth in income, some in bonds? It's up to the client. The only time the client can self-direct funds is in a variable universal life policy. So let's review. The least that's paid when you die is death benefit option A. That's the face amount. Is it possible that you've paid extra for death benefit option B, that the face amount plus the cash value is paid when you die? Yes, you could have done that. And VULs, the premium is a target. It is not fixed. You would have to have your Series 6 or Series 7 license be registered with the NASD. This product is regulated both at the state and federal level. So variable universal life. That concludes our discussion of big letter B, your interest-sensitive products. Page 4 is term insurance. Term insurance, we briefly talked about. We said that term insurance is less expensive than whole life. It is pure protection. It has no cash value. It's least expensive in the short run, but it's most expensive in the long run, term insurance. It is temporary. It's good for a period of time. Time. So if somebody has limited financial resources and a short-term need, term insurance would be perfect for that type of a client. So term insurance, we're going to start off by discussing a policy called annual renewable term. ART. Annual renewable term. Here's the face amount, just as it's always been, $100,000. Now when you first buy this policy, let's say you're age 30, you do have to pass a physical. You do have to go through underwriting in the beginning. And let's say your first year's premium is $100. With annual renewable term, every year it gets more expensive. But they do allow you to renew it. This is a marketing tool. It is renewable without a physical. So if I was healthy at 30 and then I get sick during the year, can I renew it at age 31? Yes. Regardless of health, without having to prove insurability, no matter what, I can renew it so long as I do what? Pay the next premium. And because statistically speaking, I'm older and closer to dying, every year, annual renewable term will get more expensive. Do I have to pass a physical at age 32? Nope. And so on and so forth forever. So the face amount stays the same. The premium, if it's annual or renewable term, goes up every year. But it is renewable no matter my health. Another type of a term product that has been invented that is quite popular actually is called level term. So level term, it's important for your client to understand exactly what it means. Commonly, your client thinks level term means that the premiums will never change. No, not necessarily true. So level term, what it refers to, number one, is that the face amount of the policy is level. Number two, it is true to say that the premium is level for the term. For the term. So I'll give you some examples. So the premium is level for the term. So once again, we're all 30 today, whether we're ready to be yet or not. At age 30, you purchase a 10-year level term, same face amount, $100,000. In a 10-year level term, your premium is the same for the first 10 years. So it's basically based upon your average age of 35, and it does not change for the first 10 years. At age 40, I can renew it. It can be renewed no matter my health, so renewable without a physical. At age 40, if I choose to renew it, I have to pay the premium that's associated with age 45, and the premium would stay the same for the next 10 years. Now, did the face amount change? No. Level term means that the face amount is level. The premium is level for a period of time. So if I renew it here at age 50, I would pay the premium associated with age 55. More popular than 10-year today is 20-year level term. Purchased at age 30, your client would know exactly what they have to pay for the next 20 years. So they basically pay a premium associated with the age of 40 over the 20 years. Their face amount does not change. Could they renew it out here? Well, probably, but it's going to get to be quite expensive out there. Your premium would be based upon age 60. They could also buy a 30-year level term as well. In a 30-year level term, how long do you think the premiums would stay the same for? That's right, 30 years. So you would pay a premium based upon your middle age of 45. your face amount never changes. Level term. When you renew it, you do so without a physical. So it's important to remember the face amount is level and the premium is level, not forever, but for however long they've locked it in for.